It is the Fed decision. First interest rate cut since 2020, COVID. We've got a bet going on at the office. So we've got the portfolio team. We're talking to them right now. One of our portfolio managers expects a 25 basis point cut. With the market heading lower initially, but closes up 23 basis points. One of our portfolio analysts, 50 basis point cut, with the market up 15 basis points at close. And I came in with a bold one, 50 basis point cut, with the market up around 100 basis points at the close. So currently, right now, investors are pricing in, somewhere around a 60% chance of a 50 basis point cut. JP Morgan is the only major bank that is showing a 50 basis point cut. Everybody else is on that 25 basis points. But, just some historical context. So the last two instances that the Fed cut rates by 50 basis points, the S&P saw some pretty significant declines because that was in response to some pretty bad times. So 2001, 2020, 2008. And those declines were, 15% in one and 22% in another. But, conversely, in a rate cutting cycle where they only did 25 basis points, the market was historically higher 12 months later. And that was really just because in that period of time, the market wasn't in a good position. We were heading for a recession. The Fed had to cut rates pretty dramatically for that reasoning. But, I think it's going to be an interesting day. And, I wanted to share some thoughts on who really benefits from this rate hiking cycle. And that's people with cash on the sideline. So whether you're a retiree, a wealthy investor, not middle America really doesn't really benefit from these rate hiking cycles, right? Interest at the bank. So you think of that as like savings that you have. Most people are really just trying to get by, paycheck to paycheck, especially with rising prices. So the people who've really benefited from this rate hiking cycle are the people that have been able to actually earn interest on their cash or on their investments. And that's the downfall of inflation, right? The middle class really gets crunched by inflation, and they get harmed the most by rate hiking cycles because they have to pay a lot more for credit card debt, or they have to pay a lot more for mortgages, where most times the people that have the investable assets, they get to benefit from that, 5% CD rate or 5% money market rate. But those are about to change. And those are things that we talk to about with our clients is, when we're looking at making investments in those safe money buckets, thinking about looking at things a little bit more longer term, thinking about extending duration, thinking about investing in things, not just like what the highest 6-month CD rate is or what the highest 12-month CD rate is, because this is the first of potentially many interest rate cuts over the next year or so. The market is currently pricing in somewhere around 100 basis points or 1% in interest rate cuts over the next 4 months, so before the end of this year. And that has a big impact on savings rates. So all of those people that have been just saving in money markets or what I call CD chasing, you have duration exposure as those CDs mature. What are you going to be able to renew those new ones at? So we made it a point in a lot of our conservative portfolios to try and extend that duration by buying 2-year, 3-year, up to 5-year bonds in clients' portfolios to make sure that we can lock in that higher yield so it's not affected as much when the Fed cuts interest rates. We don't have that reinvestment risk. But we're getting pretty close to this Fed announcement. It's going to come any second now. And let's just see any last bets from the portfolio team. But in a non-recessionary rate cutting environment that starts with 25 basis points, you've seen an average increase of around 10% over the following 3 months for the S&P 500. But a 25 basis point cut, on the other hand, could be seen as a proactive cut. Here it comes. Here's the news. $50 basis points. Wow. So one of our portfolio managers is already out. 50 basis point cut from the Federal Reserve. It's in the new Fed funds rate, 4.75 to 5%, 50 basis point cut. So let's see how the market is taking that. And the market's rallying. Market's currently up 63 basis points, a little over 0.5%. And like, this is something to kind of, remember is, historically, if there's no recession following the first rate cut, the S&P has seen an average increase of around 15%. So, are they making these rate cuts because they see a potential recession? That's going to come out in some of the language that we're going to get in just the next few minutes. But for me, I would look at it as more of a positive, right? So as the market, kind of digest what's going on within the underlying economy, if you take out the responses to the big interest rate cuts, like the first one in 2020 during COVID, or 2007 during the global financial crisis, or even the internet bubble that was bursting in 2001, this may be for a good reason, right? So the Fed funds rate is over 5% right now, while CPI or PCE inflation is somewhere around 2.5%. So there's a lot of room for them to get interest rates back down to neutral. And as a reminder, the importance of, kind of where we're at from a macro perspective, while there could still be some growth scares ahead, I don't think that there's going to be that big of a chance of a recession in the near term. You still have more job openings than people employed, when typically it's the other way around. Unemployment is still low at roughly 4.2%, even though it's at a 3-year high. GDP growth is still somewhere roughly around 3%. And the Fed should probably cut multiple times, but due to a good reason, on inflation coming down versus in response to a crisis. So we got 50 basis points cut. One of our portfolio managers is most likely going to have to buy the office a burger. So we bet a burger on what the rate decision was going to be. You can kind of see right now some of the interest rate sensitive sectors of the economy, and some of the ones that benefit most from rate cuts are doing the best, with financials up, technology up, consumer discretionary up, all the areas that should, improve with lower cost of capital in the economy. But there it was. We got 50 basis points. This is Andrew Whalen from Lake Arrowhead. I hope everybody has a great day. Thanks for joining in, and we'll talk to everybody soon. Thanks. Bye.